Everyone, this is another video about money and finance, Impact Financial. That's our channel, and that's what we talk about. Today, we're going to be discussing CPI. How does it relate to inflation, and how does it affect you as a consumer, as a borrower? CPI and inflation, they're related. What is CPI? Consumer Price Index. It's a basket of goods, transportation, medical care, housing, food. Think of all the essentials that we use as Americans and their cost and its relative change to month over month or year over year. So the government, and it's specifically the Federal Reserve, which is independent of the government, independent bank of the Federal Reserve Bank, it sets monetary policy for the entire country. And what they look at specifically is CPI and inflation. And if that CPI index or inflation is moving up too fast, over 2%, 2% is really the average that they want. That's a sustainable rate. That means there's growth, and it's growth that is sustainable, and it's also not hurting the consumers as much. People are not paying more money every month for the same basket of goods. They want it at 2%. They don't want it to go above that. That's their base sustainable level. But it can go the other way as well. Deflation. Deflation is the value of goods going down. That means that everything is costing less, but usually in that situation, which is what you have in China today, basically people are not willing to pay the prices of goods that they're being set at. So retailers and wholesalers have to decrease their prices, which means usually that an economy is getting smaller. You want people to pay more for goods over time. It means there's growth, there's wage inflation, people are getting paid more, people are making more money. That means that there's growth. There are some limitations with this CPI index inflation. It does not account for substitution. So let's say a particular product or service became obsolete. Now you buy something else, and that obsolete product became a lot cheaper. If you're still looking at that obsolete product as part of this basket of goods, well, it's not really a good indicator because that product, no one's buying typewriters today. We're all buying laptops. So that, and also some neighborhoods, some demographics, let's say older individuals, seniors, they're a completely different demographic. They don't spend like everybody else. They don't work anymore. They're usually retired. So their spending habits are very different. CPI doesn't account for these changes in demographics. Let's talk about your investments, your retirement, because that's really what we love to discuss on this channel. If you are invested in the stock market, or you're invested in an index universal life plan, or you have bonds, you are affected by CPI and inflation greatly. So when CPI and inflation is increasing, well, now the Federal Reserve has to increase the interest rates because they want to slow down inflation. They don't want it to get out of hand, some like a Venezuela or a Zimbabwe, some of these countries that cannot control inflation. The value of their currency, well, it's worth nothing at some point. You need a barrel of currency like you did in World War II in Germany just to buy a loaf of bread. That is not an economy that's functioning properly. So that's the last thing that they want. So they increase interest rates so they can combat that inflation, which in 2022, I believe we hit 8-9% in inflation, which is way too high, way over 2%. And so the Federal Reserve jacked up interest rates from basically zero. Now they're well over 4% with the Federal Reserve. And so everything, the cost of borrowing everything, a home, a car, everything is more expensive. Instead of interest rates at 4% or 3% or 2%, which we saw in 2021, 2022, we're looking at 7, 8, 9, 10%. It's a big difference. So this is a way to slow down the economy. It's a way to slow down spending, and it's a way to slow down inflation so things can normalize and the cost of goods can normalize as to what they should be in a normal environment. How does this affect your investments? Companies that you invest in, Apple and McDonald's, two of the most well-known brands in the world, these companies are pretty much immune to higher interest rates. They're not borrowing much to grow. They don't need to. They generate a lot of cash flow. They can use their cash flow to reinvest in their business for growth. And so other companies that do need the money to grow, well, yes, they're going to be affected because now their growth is affected. And if their growth is affected, usually the value of their stocks or their business in general, it's based on how fast they can grow. People are investing in their growth. They're not really investing their cash flow. A lot of times, majority of these companies, they're not making any money. They're actually losing money every single year, but they're able to maintain their operations because they're telling investors, hey, we're growing at 40%. Tech companies, for example, we're growing at 40%. We're growing at 50%. And we expect in 3 years to be triple the size we are today. So that is a way that these companies tell investors, hey, at some point, we're going to be so big, we're going to have a huge addressable market, and we're going to be able to generate a ton of cash flow and return your investment back to you, back in the form of dividends, give you income, so forth. And so all investors want that. All investors want to ride a growth company up to its profitable years. That is the goal when you're investing, right? Get back to the conclusion here. Inflation and CPI is a huge factor when it comes to monetary policy in our country, and it affects everything from you as a consumer when you're buying a home or a car or a loaf of bread, or you as an investor, or you when you're retirement planning. It affects corporations. It affects everyone. This is very important. To learn more about this, please see the description. We have a blog link in there. There's more detail on everything that we just talked about in this video. And thank you so much for joining us again. Please comment and like. Appreciate your feedback. And please subscribe to our channel. We want to keep bringing you guys more content that's going to be valuable to you. And if you have any tips for us, leave that information in the comments section below. Thank you so much for joining us, and until next time.